Welcome to the deep dive. We're jumping straight in today because, well, the market action for the week ending Wednesday, October 22nd, has been pretty confusing.
It really has. You shared some great sources, and they all point to this kind of split personality in the market.
Right. How do you get a strong defensive rotation happening at the same time as a major crash in those high momentum stocks? It feels contradictory.
It absolutely does. Almost like cognitive dissonance playing out in real time. So our mission today is to try and, cut through those mixed signals, see where the capital is actually flowing and maybe where it's fleeing from.
Okay, good. Before we get to the momentum crash part, let's set the stage, because there were actually some potentially positive signs in the background, weren't there? Earnings, obviously, but also bonds.
Exactly. Earnings season is definitely underway. We saw Netflix, Tesla report. But maybe the biggest macro driver, like you said, was the bond market.
The 10-year yield.
That's the one. It dropped below that really key 4% level, psychologically important, technically important too. And it closed below 4% for 4 out of the last 5 days.
And why is that 4% mark so critical again?
Well, it often acts as a sort of proxy for the risk-free rate that gets plugged into a lot of valuation models,
Yeah.
especially for companies expected to grow way out in the future.
Ah, right. So if that long-term borrowing rate dips below 4%.
It should, in theory, immediately help stock valuations. It lowers the discount rate investors use for future earnings, making those future profits look more valuable today, which, should boost stock prices.
And it also sort of confirms the story that maybe inflation is finally getting under control.
Precisely. That narrative gets a boost. And usually, that's a fantastic tailwind for stocks. But the market's reaction this week, let's just say it was a bit muted.
Muted is a good word.
Yeah.
Looking at the big indices, Dow, Nasdaq, Q, S&P 500, they were barely up. S&P gained, what, 0.42%? Just fractional moves.
Tiny moves overall.
So if the broad market wasn't really going anywhere, what was working?
Well, interestingly, transportation stocks were actually leading. They gained about 1.44%.
Okay, transport's leading. That usually signals economic health, doesn't it? Goods moving around.
It does suggest that, kind of a classic signal. But you have to contrast that with the pretty significant weakness we saw in small caps.
Ah, the IWM. Yeah, I saw that dropped quite a bit.
Nearly 3% down this week. And that's interesting because they had actually shown some leadership in the period just before this.
So, transport strong, small caps weak. It almost feels like investors are saying, okay, we believe in the big economic picture maybe, but we're getting nervous about the smaller, riskier domestic companies.
That's a great way to put it. And it feeds directly into that massive defensive rotation we saw. The mood definitely shifted more towards risk off.
So where did the money go? Which defensive areas outperformed?
Okay, so the data shows 4 key defensive sectors beat the S&P 500. Consumer staples.
The necessities.
Right. Real estate, energy, and healthcare. Those were the leaders.
And on the aggressive side?
Only one area kept up consumer discretionary. That was the sole aggressive sector that managed to outperform the S&P.
But the real story seems to be the lack of leadership from the biggest players, right? Technology.
That's absolutely critical. Tech just matched the S&P 500's performance. And when you think about it, technology makes up, over a third of the S&P 500? And over half the Nasdaq Q 100.
Yeah, it's huge.
So when tech is just kind of sitting there, not leading, not lagging dramatically, it's a pretty strong signal. It tells you institutional money isn't really chasing the market higher right now. They're looking for safety or maybe specific value plays.
This feeling of caution, it really carries over in the technical picture too, doesn't it? The charts seem to be flashing some warning signs.
They absolutely are. We really need to look closely at the S&P 500 chart, the SPX. The sources are pointing toward a potential classic correction pattern playing out, an ABC pattern.
Okay, break that down, ABC.
Right. So phase A was that big sharp move down we saw 2 Fridays ago. Remember that?
Yep, nasty day.
Then phase B was the rally back up, trying to get near the old high. Kind of a bounce.
Okay.
And phase C, which seems to have started with the weakness we saw on Wednesday. Well, that suggests the market's now rolling over again to finish the correction downwards.
So if this C wave plays out, what's the potential downside? Where does it likely bottom?
The technical projection, based on this pattern, points towards the 20-week exponential moving average that's sitting right around 6,419 currently.
6,419. And hitting that level, is that bad or just normal?
That's the key point. Testing the 20-week EMA is generally seen as a pretty routine thing on a weekly chart. It's often a healthy consolidation, allows the market to reset a bit. It's not usually a sign of a, complete market collapse.
Okay, so maybe more volatility, a bit more downside to complete the pattern, but not necessarily panic stations yet. And the Nasdaq Q is showing something similar.
Very similar pattern in the Nasdaq Q100, the QQQ.
Oh, great.
And that makes Thursday's trading action even more critical for the Nasdaq Q.
Why Thursday specifically?
Because if the Nasdaq Q takes out Wednesday's low point, it could really accelerate the selling pressure, especially when you factor in things like Tesla's after-hours performance on Wednesday, which was already looking weak.
Right, those big tech names have such an outsized influence. Let's just quickly touch on a couple of specific sector charts that really show this rotation. Utilities, for instance. They had a rough week.
Yeah, utilities are usually a safe haven, right? But
Hmm.
they printed a pretty ugly bearish engulfing candle recently, followed by 5 straight down days.
Oof.
They're now testing their 20-day moving average right around the $90 level. If that doesn't hold, you could easily see them slip back towards the $87 breakout point. So even safety trades are getting tested.
But not all defensive areas.
Yeah.
Healthcare looked stronger.
Healthcare actually had a very strong week. Strong performance 4 out of 5 days. It's heading up towards resistance, maybe in the $147, $148 zone. And the momentum indicators, like the weekly PO, are accelerating upwards.
So money is definitely being selective, even within defensive sectors.
Very selective. It's flowing into specific pockets of perceived safety and strength.
Okay, that selectivity brings us perfectly to the big earnings reports, because these seem to be the real catalyst for what you call the momentum massacre. Let's start with Netflix. Missed estimates, and the reaction was, well, ugly.
Ugly is one word for it. Distribution is the technical term analysts are using.
Distribution,
Huh.
meaning big institutions selling off shares.
Exactly. Big funds, the so-called smart money, actively unloading shares onto the market. It wasn't just a dip. The stock gapped down below a key intermediate support level.
And the volume.
That's the kicker. It did this on the heaviest trading volume Netflix has seen in the past year. That is a classic signature of institutional selling, maybe even abandonment for the time being.
Wow. And when you see that kind of heavy volume selling, that distribution, where does the price likely head next? What's the target?
Well, the minimum technical expectation now would be for it to fall further and test the breakout level from way back in April. That's down around the 1060 to 1065 area.
So quite a bit lower still.
Potentially, yes. That huge volume suggests that support level really needs to be tested and proven solid before any kind of meaningful recovery can start.
And then there's Tesla.
Yeah.
We didn't have the full report reaction by Wednesday close, but it was already trading down after hours.
Yeah, down about $15 or 3.5% in the after-hours session on Wednesday. And look, when you have two massive stocks like Netflix and Tesla taking significant hits like this,
It just weighs on everything, doesn't it?
Yeah.
Especially the Nasdaq Q futures.
creates a huge drag on sentiment. It's a vacuum effect, really. When those former leaders stumble so badly, investors immediately start looking for safer alternatives. And that, I think, is why this pivot towards value in these seasonal setups is so pronounced right now.
Right. Let's talk about those areas of strength then. The counter-narrative stocks that are actually setting up well, despite all this market fear. You highlighted Applied Digital, APLD, as a high reward to risk play.
Yeah, this one looks like a pretty textbook setup, actually. Fundamentally, APLD had a huge revenue, beat $64 million versus estimates around $50 million. And their loss per share was much smaller than expected to.
So, strong fundamentals. What about the chart?
Technically, it pulled back really nicely. It filled a previous price gap on the chart and came right down to test its rising 20-day moving average. That's a key support zone, right around $29.50 to $30.
So that's the potential entry point.
That's the key level. If buyers step in there, which the pattern suggests they should, the potential upside target could be back towards the $40 mark. It shows the market will reward good news, even in growth names, if the technical setup is right.
Okay, good example. Now let's shift to what you called the value seasonal trade. This is fascinating. You're combining solid company results, good charts, and the fact we're heading into a historically strong period for the market.
Exactly. We looked at data going back to the confirmation of the secular bull market in 2013, and based on that, certain stocks and certain sectors show incredibly strong seasonal tailwinds right now.
All right, let's hear them. First up, Delta Airlines, DAL.
Delta. Great earnings report, beat on revenue, beat on earnings per share. The chart shows what technicians call a cup pattern, and it's currently pulling back into a tight handle formation right near its key moving averages. Classic consolidation setup.
And the seasonal kicker.
It's huge for Delta. Historically, November has seen DAL finish higher 83% of the time since 2013, and the average return for just that month, 9.5%.
Wow, 9.5% average gain in November alone. That's a powerful reason for money to rotate in.
Absolutely. Okay, next. CSX Corp, the railroad. Fits that transportation theme we mentioned earlier, but from a value perspective.
Right. How did CSX look?
Fundamentally solid, like Delta beat revenue and EPS estimates. Technically, this one's really interesting. CSX has basically been consolidating, moving sideways for about 4 years.
4 years.
Yeah, a really long base. And it's right now on the verge of potentially breaking out from that huge consolidation. Plus, its relative strength compared to other railroad stocks is near a 10-year high.
Strong performer within its group. Seasonality.
Also very strong. November has averaged a 7.7% return for CSX, and the stock has risen in 11 out of the last 12 Novembers. It's the definition of a quiet, powerful rotation candidate.
Okay, next. American Express, AXP, sticking with quality value.
Yep. High-quality financial name. AXP just broke out on its chart after, again, beating analyst estimates on both revenue and earnings. Solid fundamentals driving a clear technical breakout.
And November for AXP.
Averages a solid 6.8% return historically. You see the theme. These are established companies delivering results with good charts, entering their best seasonal period. It's a compelling combo compared to the momentum names getting crushed.
Definitely. And the last one you highlighted was General Motors, GM, which apparently had a huge earnings beat.
It absolutely did. The stock is breaking out now, moving above its high from early 2022, so it's basically entering uncharted territory. And importantly, it did this on the highest trading volume GM has seen in a full year.
Volume confirming the breakout. That's a strong signal. Seasonality for GM.
Also excellent. October averages 6.3%, and November averages 7.0%, rising in 11 of the last 12 years for both months. This is where it looks like institutional money is rotating, seeking safety, yes, but also potential high returns in these value names.
It's such a stark contrast. Which brings us back to the other side, the momentum massacre. This really underscores the risk of chasing those super high-growth, high-momentum stocks, doesn't it? When sentiment shifts, they fall fast.
Like rocks. I mean, look at the stock iron, ticker IN. It lost over a third of its value, in just 6 trading days. Dropped from nearly $75 down to a low of $48.
Just brutal.
Or Bloom Energy fell from $126 down to $88 in that same 6-day window. The speed of these declines is just breathtaking. It forces a total rethink for anyone who bought near the highs.
But the story around OKALO, or ALO, that seemed to raise different, maybe more disturbing questions about how these markets work sometimes.
Yeah, Olo's drop was also a catastrophic high of $195 down to a low of $114. But the analysis and the sources went deeper. It highlighted the potential role of market maker incentives.
Incentives? How so?
The sources suggested that in the prior week, market makers potentially had a massive financial incentive, maybe up to $100 million for Olo's stock price, to fall specifically to the $130 level by options expiration.
Okay, hold on. $130 was the max pain level, right? Can you just quickly explain what max pain means for listeners?
Sure. Max pain is the stock price at which the largest number of options contracts, both puts and calls, would expire worthless. This causes the maximum financial loss or pain for the people who bought those options.
And maximum profit for.
Maximum profit for the people who sold or wrote those options. And very often, the big options writers are the market makers themselves.
So the implication is, if there's a huge incentive for the stock to hit a certain price where options expire worthless, the price might get pushed there.
That's the suggestion. When you see a high-flying, maybe speculative stock get slammed down aggressively towards a known max pain level, especially when there's potentially a $100 million incentive involved, it raises serious questions about whether organized pressure was applied to, well, manipulate the price to that specific point for expiration.
That really adds another layer to understanding that volatility in the momentum space.
Yeah.
It wasn't just random selling, perhaps.
It suggests maybe not entirely random, no. And we saw other former high flyers hitting key technical levels, too, like NBIS hitting its 50-day moving average around $98. CleanSpark, CLSK, dropped hard from $23.50 down towards $16.
So the clear message from that part of the market is,
the speculative money that was driving those incredible runs has just vanished, basically evaporated. Investors are being forced back to fundamentals, back to reality, which means buying quality earnings, solid technical setups, even if they're in sectors previously considered, boring.
Okay, before we try to pull all this together, just a quick word on commodities. Gold saw some surprising action too, didn't it? Especially given the defensive shift elsewhere.
Yeah, it was pretty wild for gold. Despite the risk-off mood potentially favoring it, gold, the GLD ETF, actually dropped 9% in just 2 trading days, fell sharply from around $403 down to a low of $368.
9% in 2 days. That's a huge move for gold and the miners.
They got crushed, as you'd expect. Agnico Eagle Mines, AEM, as an example, took a hit of about 27%, dropped from the 185% $88 area down to a low near $158.
So why would gold sell off like that when investors are supposedly rotating into defensive assets? Seems counterintuitive.
Sometimes, in really sharp, almost panicky sell-offs, everything gets sold initially as investors just raise cash, liquidation across the board.
Yeah.
However, the standing theory, the normal expectation, is that if this overall stock market correction continues, and if the VIX, the volatility index, keeps rising, then money should eventually rotate back into gold as that classic safe haven asset. So that sharp drop might just be a short-term shakeout before the real safe haven buying kicks in.
Interesting. Okay, let's try to synthesize all this for everyone listening. It's a really complex picture. We've got this clear rotation into defensive stocks.
Right, staples, healthcare, energy, real estate leading.
We've got technical warning signs on the major indices, suggesting maybe an ABC correction is underway, needing to test lower levels like that 20-week average on the S&P.
Potentially down to 64.19 or so, yeah.
But at the same time, we're seeing massive fundamental strength and really compelling seasonal tailwinds setting up in specific value stocks like GM, CSX, Delta.
Exactly. Huge earnings beats, strong charts, entering their best time of year historically.
And we need to overlay the historical context here too, right?
Yeah.
The specific week we're in is notorious.
It is. We are right in the middle of what is historically considered the worst week of the year for the stock market. That context alone naturally tends to amplify any selling pressure or volatility we see. It often forces these kinds of corrections.
So maybe this pullback, this rotation, this momentum crash, it's all part of the market resetting itself during its weakest seasonal patch, preparing for what comes next.
That seems like a very plausible interpretation. It's clearing out the excesses.
Which sets up the final question perfectly. Because the most bullish period of the year, historically, begins right after this weak patch, ends literally at the close of trading next Monday.
That's right. The historical weakest period gives way to the strongest.
So, given everything we've discussed, this defensive pivot, the technical warnings playing out, the absolute collapse in those high momentum names, the big question for you, the listener, to ponder is this. As the market makes this transition from its historically weakest point to its strongest seasonal period, which sectors, which types of stocks, having weathered this storm, are best positioned to capture the bulk of that incoming capital?
That's the multi-million-dollar question, isn't it? The key will be watching which of these defensive and value names, the ones showing relative strength now, can really accelerate when that positive seasonal tailwind truly kicks in. That dynamic is likely what defines the rest of the fourth quarter.